You are listening to Mining Stock Education.
It's Mining Stock Education, and I'm Bill Powers, your host, speaking with my co-host, Brian Leni. Thanks for the last year of listenership. And in the week between Christmas and New Year's, something Brian and I always do is look back on the past year, what we did right, what we did wrong, what we could grow in, and take those reflections into the new year, 2026, to hopefully become better investors. So in today's show, you're going to hear us talk through some of the things that we've learned and have thought about in this week, this reflective week before the new year kicks off. So Brian, thanks for this discussion. A lot of the things I'm going to share as I reflect back, you've already heard just from conversations we've had. And I guess that's my first point of reflection in looking back over the last year, is that if you really want to invest larger sums and be successful, you need key partners to look at specific investments or to give you feedback on your emotional state. You've even at times given me feedback to where you say, okay, you might be motivated by greed right there, or you might be a little naive in taking that promoter statement at face value. And so one of the things when I looked at my notes over the last year, and this is more in relationship to direct investment into companies. And for those that don't know, what I mean by that is like via a private placement where you send money directly into the smaller cap resource stock when the executives are raising money to fund what they say is the vision for that company, rather than buying the stock on the open market. So when you're dealing directly with the promoter or the executives, they're giving you the forward-looking statements. You're giving them this money because it's a high risk, high reward, oftentimes proposition. You're looking for an outsized gains, and they're making these statements to you. So one of the things that I wrote down, Brian, is if I'm going to invest a large sum of money again, reflecting back, particularly on like the 2022 to 2024 timeframe, I'm never going to do it without at least one other set of eyes of somebody that I've had a multi-year relationship with that I know is skilled enough to look at resource stocks. And you obviously are one of those people in my Rolodex. And I want to just mention, as I was reflecting, a company that you and I looked at a few years ago, 2 or 3, whatever it was. And I was approached by a group about a pre-IPO for the NYSE. They said they wanted to go on the NYSE, an energy company in the States. You and I took the meeting. We looked at it. We were told about a seed round that we could invest in, if you recall. And not only was the energy thesis not that compelling, when you got to the point and you asked the CEO about the share structure in regards to options, if you'll recall, the options would literally double the share count from the share structure that was being communicated to us. Any reflections you have on that or anything I've said thus far?
Well, I think you're bang on, especially when you reflect and you find the things that specifically hone into where you've made mistakes or what makes you comfortable in making decisions into the future. I think that's like paramount for any investor, is to be that self-reflective and obviously come up with this formulaic plan on how they're going to apply decisions in the future. Specifically with the situation you're talking about, I recall quite vividly. And, and part of my reflection was thinking about management teams and thinking about not as much just what they do, but what they don't do. And, in this specific situation, I think it wasn't confusion, but there was also some maybe defensiveness about even asking about share structure, or in other cases that we talked about last month, where you ask a question about G&A or the number of components on a management team in reflection to where that company is in their story or their development stage. And, how that applies, and the defensiveness that these management teams sometimes can give. And to me, it's like a telltale sign that there's something there, whether the management team knows that it's not a legit scenario where they've been overly generous with themselves, or they're carrying more people than they probably should for a number of different reasons. But how that management team reacts to different questions that should be, prototypical questions that every investor typically ask. And, I think it does catch some of these guys off guard, especially in situations where they're trying to raise large sums of money from people, obviously, with the two of us that they wanted to raise money from. And you hit on a point that obviously, sparks importance, and they're sort of afraid to maybe get into the weeds of that. And so it's a really good topic, and I think is rooted in how you started with the self-reflection, and that's why we both do this. And I think every investor, there's not going to be, you listen to Bill and Brian and say, hey, I need to apply this to myself. Maybe it is. But the whole point is that you are introspective and you come up with a framework. Don't just take the points that we're making and make that verbatim, which you need to follow too.
Yeah, those are great points, Brian. Another reflection that I've had as I've thought back over the last, I would say 3 to 4 years, and conversations that I've had with very wealthy people that have done well in speculative small caps. Number one, each of them, if I've talked to them for any extended period of time, and I tend to ask a lot of inquisitive questions, they will share a story about a big loss they had in which they felt like a promoter or the fundraiser lied to them, and they lost because of that. Number two, that when they've had a big win, they didn't attribute it all to their skill, but rather they acknowledged the role of luck. Any reflections on that?
Absolutely. Actually, one of my mentors continually refers to it being lucky. And actually, it's quite funny you bring that up, because this past weekend I had a conversation with a mentor, and he wrote in the email in response to a question I asked him. He said, I've been exceptionally lucky with a couple of positions that we both had exposure to. And he said it's time for me to move on from those positions. It didn't really lay out, but he started off with how lucky he was, and he was looking for other things. And, that gave me pause. And I thought to myself, wow, he's moving on from a couple of positions that I don't necessarily think are done, but it does give me pause into saying maybe I should be taking more money off the table. He has an uncanny ability to time his profit taking in relation to both the company and the market cycle. And, the more more experience I've had in this business as an investor, the more that comes to the forefront, with profit taking being so vitally important. And, we get into these situations, you look at the silver market, and actually I think or at least I touched on this in our last conversation with the amount of hype, and the amount of hype has only gone up since we last spoke last month. And, everything in the silver market looks exceptionally good. And like I said before, it wasn't as much that I was bearish on where the silver prices was headed. It wasn't the case. It's just when you see the amount of people and the amount of only positive stories in reflection to where the silver price is headed, I think that should give everybody pause. These metals markets are incredibly complex, and you're missing something. And I'm not saying I know what you're missing in the silver market. What I do know is that I probably am missing something, and I'm not going to bet fully on the silver price going to $200 an ounce or $300 an ounce with any investment decision I'm going to be making. I'm going to continue to do the same things that I've done over the last 10 plus years now as a full-time investor. And that has gotten me into the place where I've been completely independent. I continually make money. And, I'm talking on a podcast about investing. So if these are the sorts of things that you want, I think, more often than not, more people need to frame themselves and take a look at what's going on in the market, where the hype is, and reflect that into how you're approaching deploying money and taking money out of the market, because nothing goes up forever and nothing goes up in a straight line. And I'm not saying silver is going to fall back to $20 an ounce. And I'm definitely not saying it's going to 200. But if it is going to 200, it's not going there in the next 2 months. I don't think you're going to have corrections along the way, and maybe eventually over the next X amount of years or at least multiple months, you're going to get there over time. So the bottom line is that, being self-reflective means taking a look at your whole picture as an investor and picking apart these different components. And, exactly what you say is, the importance of mentorship, the importance of network, and how that plays into how you make your own decisions. Who you're going to let influence you, matters a lot. And for me, my relationship with one mentor in particular, he's both a mentor and a friend. And I take his view of the market extremely seriously because it's been a huge component of the success I've had. And like I said, that small conversation definitely influences the way I've been thinking moving forward and probably will act in the new year.
One of my reflections is on my relationship with my bullion, precious metals. That's how I got into junior mining stocks. I was buying silver from $22, $23 all the way down to $14. And then in late 2015, that's when I said, hey, I got to look at a leveraged way to profit off of silver's expected rise. So when I think about my relationship with my physical bullion, it is savings, it is insurance, and it is liquidity. I don't view it as like a trend, chasing the trend to get a nice profit trade, because I'm seeing that on social media, Brian, where people that aren't positioned in silver don't have physical bullion as a foundation, in my opinion, of their portfolio. And there's so many people too, I mentioned wealthy people that I've talked to, Brian. They don't own any physical precious metals. They don't own physical gold or physical silver, which you and I would say would be the foundation probably of one's portfolio. So that's how I view it. And if you recall 18 months ago or a year ago, when I did sell some of my bullion at a profit, and I took that money and I invested it in a piece of equipment for a business I owned, I called you and I told you, I'm committing the cardinal sin of precious metals stackers by walking into this business and selling this in exchange for US dollars, which then I transitioned into a piece of equipment. And, but I remember what you told me at the time. You said, Bill, it did exactly. You're selling it for a profit and it's accessible when you need it, and you're putting it into something you think you can make money with. And so I am a stacker, so to speak, but I guess I don't adhere fully to the stacker's mentality that you never sell. Any thoughts here, Brian? What's your thoughts on how we relate to our bullion?
For sure. And I think first and foremost, it is an individual thing. I don't think, while I do think that bullion is like a sort of a baseline for investors, or should be, it definitely doesn't apply to everybody. I think like the common theme, or what we would say, is that it has to suit you and whatever you want it to be. And for some, owning the physical metal just doesn't work. And I can see why it doesn't, because it isn't, especially if you don't live near a big city, it isn't the most convenient thing to transact, and the security aspect and these sorts of things. So I see that sort of side of things. I still would prefer, I think, people have that, especially in the environment we're moving forward to. But I think that's first and foremost. Second, absolutely, that is, to me, exactly what precious metals is supposed to do. It's supposed to maintain your purchasing power. So when you need to buy something, whether that's something for a business, a car, or some home improvement that you need to make for your family to make life better, that's exactly what it's supposed to do. The whole idea with never selling it, again, if that's the way you want to operate, then that's your prerogative. And if that's something you just want to pass on to your kids, again, to each their own. But to me, it's maintaining purchasing power. It's whatever we're moving towards, whatever is ahead of us in terms of this monetary reset, or whatever that looks like. There's definitely change ahead. I think that people are going to want to own precious metals in some sort of way. And I'm not talking about the equities. I'm talking whether it's the physical metal or exposure to the physical metal in some digital manner. And you need to maintain that purchasing power, because I think everything points towards further devaluation of currency, and whether that's USD, especially the Canadian dollar, but any of those fiat currencies that are around the world, you need to preserve that purchasing power. And I think precious metals is the best way to do that. But probably any real physical asset is a way that you can sort of do it. Again, they all come with their pluses and minuses. And as an investor, you need to decide which works best for you.
As I've reflected again over the last 2022 to 2024 and what I can learn. Early 2025, I bought a ton of books on the history of con man and grifters, mostly in America, like that's 200 years, and studied some books on the psychology of that. And I did so, Brian, because again, with direct investing, you're dealing directly with a management team that is making you promises and telling you what they're going to do. So you're not just listening to something, you can listen to the CEO of a big gold miner or a big nickel miner or BHP. You're never going to talk to those guys. They don't even have you in mind when they're laying out. The company's so huge, right? So we speculate in small companies that we hope become big companies. And so I wanted to do an assessment of and better understand the psychology of a con man, but also my personal vulnerabilities with how they play the game. Now, different con men are sophisticated to a different degree or not. So part of what I share will be in following is the more sophisticated type. And one of the things my studies led me back to was where the term con man even came from. And it went back to about 175 years ago in America, in New York, where there was a swindler that would go around the streets of New York. He would dress nice. He would go up to random strangers and he would act like he knew them. So one of the things he was doing there was trying to take advantage of that cordialness or just the gentleman nature of how one should interact with another. And as he's interacting and acting like he knows them, the person is thinking in their head, oh, you know how this is, you're at a party, you're like, I don't remember. They're talking to me like they know me, but I don't remember that conversation or I don't remember their name. And so you feel a little guilty, right? And you don't want to say, I'm sorry, I know you act like you know me, but I don't know you, right? So that's part of the psychology of how this guy would go in. And then he would just matter-of-factly say, after talking to them, do you have confidence in me to trust me with your pocket watch until tomorrow? And he would literally say that, do you have confidence to trust me? And so because of that dynamic and the person not wanting to say, I don't really remember who you even are, and just being confronted with that, do you trust me? Many people would give him their pocket watches and he would go away. And so he collected hundreds upon hundreds of pocket watches until it eventually came up with him. So that's where the term originally came from, one that will gain confidence in what they would call a mark or a target in order to take advantage of them for the con man's own financial benefit, to the neglect and the detriment of the mark, the person that was taken advantage of. And when you look at more modern day psychology and studies of con men, people that have actually sat down with them and talked through and tried to get into their head, a couple things came through. Many of them were actually very good listeners, but they weren't listeners in how a counselor should relate to somebody, one of their clients, and that I'm listening so I could help you detect, what's going wrong, so I could offer you solution or wise advice to help you with your situation. They're listening to try to find vulnerabilities, where the weaknesses are in the person that they're targeting. And where many, hopefully, would have like a moral mark to say, I'm not going to take advantage of this person once pinpointing where they are vulnerable. The con men would try to take advantage of that and capitalize on that. And there was no morality that said this is wrong, because there was always, when they were studied, the psychology was, I'm entitled to this, therefore I can do this to take advantage of the other person. So there was not the remorse of, hey, I'm doing wrong to somebody else, but this is okay and I'm authorized to do this because it went back to self-entitlement. I deserve this thing. And without sharing some stories that I've personally experienced, I can see that now where I look where I went wrong and I invested with the wrong people. When push came to shove, looking back, that was exactly the part of the non-moral barrier, or what empowered them to cross over the line between right and wrong, was this I deserve this kind of mentality. I know I threw a lot out there, Brian, and I'll end this little mini monologue with this, is that because I am very positivistic, like I have, even when I get down, I pick myself back up, and I just believe that there's another opportunity that I can seize, another opportunity that I could take advantage of for profit potential. When you have that mentality, and then you say to yourself, surely after that meeting, he wouldn't lie to me to my face, right? Like, he really wouldn't just lie to me directly to my face when I asked him that direct question and he gave me a direct answer and didn't hesitate. Surely he wouldn't. But the reality is, no, some people will.
Yeah.
And I threw a lot at you there. What are some reflections on my little mini monologue?
Well, first, I didn't realize that was the background on Conmen. That's pretty interesting. I think, where my head goes is to, how people can sort of recognize, maybe not when you're being conned, but maybe when your attention is being drawn to something else rather than what really matters. And I think, and again, like, some of these topics are overlapped, but I think the best promoters, or where most people, and this doesn't just happen to or be focused on company reps or company executives. It can be across the stream of how people try to grab your attention. And I think macro narrative is where most people will focus. And invariably, I think what the inference is that if I can get someone captured on the silver thesis, invariably they'll buy silver in some shape or form, but they'll probably buy the equities too. And that's how it gets down to the company level. And I think especially if you have a CEO or if you have some sort of promoter for the company that wants to talk macro first and then get into why their company is the solution to whatever supply deficit or whatever angle it works into that macro narrative, that's, I think, how you can sort of tell whether they're trying to keep the attention on the big picture rather than look at the micro of the company itself, the share structure, the project points, and what really makes an equity tick. They want to stay bigger, blue sky. And so I think when you're looking at a presentation or you're listening to anybody speak, the more that they want to talk about overarching themes, I think the more you have to have your guard up, especially if you're listening to that person in regards to investing in an equity. Because again, there are so many other risks that come with investing in junior mining companies, that you can't just focus on the macro. And again, that's something, I look at what's happened, this year. It's been a fantastic market. The gold price has been unbelievably strong. The silver price, unbelievably strong. Copper is I think headed in the right direction. I think you really have to be like, those are good things, and you have to understand the points driving those metals. But you need to understand, if you're invested in the equities, all the other micro points that drive those equities forward. And you need multiple outcomes or multiple things that can drive outcome rather than just the metal price, and understand how those work in. And again, it trickles back to valuation and all these other things that are important at being an investor. But the overarching to your comments, to me, my head goes straight to how to possibly discern that somebody is trying to deflect your attention from what's most important. And to me, it's too much focus on the macro. And this is mostly reflective of company executives that are trying to sell you on their company, but they're using the macro to do it.
Brian, I've been a part of sports teams, even played 2 years of college basketball. And every practice, like when I had good coaches, you start, like, the first 15, 20 minutes are always going over fundamentals. You're just doing fundamentals. We did dribbling drills, passing drills, and you could say, like, this is rudimentary. This is too basic for where we are. You're a 19, 20-year-old and you're still doing this. But, like, this time of year, do you look back over the fundamentals of what you should look for in a junior mining stock? Or, like, how do you assess your relationship with the fundamentals of being a good junior mining speculator this time of year?
Constantly. It's constantly reaffirming or unconfirming things that are in my head. And it's all reflective of sort of the fundamentals or basics, as you sort of coin it. I think one of the biggest lessons, or the thing that I need to keep at the forefront in my head, because if I did make a mistake in 2025, it was related to this point. And it's good companies or good projects can be destroyed by structure. And that's, part of that is share structure.
Share structure. Sure.
But it's more than that. It's more than that. And it's something I was contemplating over prior to Christmas. There was this deal I came across, and I had this connection with this CEO for a long time. And I always take a meeting with him whenever I was in Vancouver, and they were a small company doing sort of small things. And I never really was that interested, but nice guy, seems honest. And I would always take the meeting. So he comes across with this deal, which we talked about earlier this year. But it's definitely gotten more interesting. And I was looking at it and I was thinking to myself, well, the share structure looks really good, but they have this JV deal. And I don't like the deal structure. To me, even though that they're having really positive drill results where I can extrapolate in my head where this is likely headed. And I look at the JV deal structure and I think, man, you put yourself in a really bad position to reap reward in the short term. And I think what happens is when these companies, they can be, share structure can be perfect. You've got the right mentality. You feel a little bit desperate. And so you do a JV deal that's too much in the majors' hands or too much in their favor. And that's how like a JV deal structure can really sort of destroy what that upside is, or the timeline on realizing that upside, which again is not necessarily a problem. But, again, it made me rethink about, looking at these deals. There's so much more to the structure of it. I think that could be parlayed. I don't know if you remember, if you go back, this is probably just prior to COVID. One of the big things that had come up is, royalty and streaming became a real thing back in the last cycle. And there were a ton of deals that were made and a ton of deals made on sort of development or exploration success. And what was found is that the royalty and streaming deals were so in favor of the royalty and streaming company that you needed like absorbent prices to make these things work. Or if you're in this sort of mediocre or sort of horizontal movement in the market, they just didn't work because it was too much in the favor of the royalty and streaming company.
You sound like Rob McEwen right now, because that's his argument. Yeah.
It's just what I'm talking about is just how the different structure of the company. It's not just share structure I'm talking about. It's just how these things can be overhangs on the company. And then you look at warrant overhangs, and this is the specific point where I could have been better. I think I was too optimistic when I made a new investment back in September. With where we were in the market and a number of other things, I was too optimistic about how that share structure or that warrant overhang or cheap financing overhang was going to be dealt with by the market. And I could have done better in terms of the entry. I think the pick is right. I think the timing could have been a little bit better. But that's sort of the basis of the point I want to bring up, is that the structure of that company matters so much. And it's more than just share structure. It has to do with if they're in a JV deal, what royalty or streaming overhangs they may or may not have, management's incentives, how options are, and it's like not just share structure, but one of the big things that really dissuaded me from a company was this change of management fee that's usually linked to a takeover. And I looked at this company's, I referred to this company the last time we spoke, but I went further. Like I looked at their G&A costs. I was like, oh, that's pretty generous. I went a step further and I looked at their break of management or change of management fee. And like the standard that you'll see on most companies is 2 times your standard salary. So it's basically 2 years salary for change of management. And that's pretty standard. These guys were like 3x, 3.5x, depending on, and they had like sub points about how they could get more than 3x on a change of management fee. And I just thought, man, like this is so, pushed over to, their favor. And it could I've also seen an experience going back, this is going back 10 years. There was an M&A deal. I didn't catch it. This is a mentor pointed it out to me because I didn't care about the M&A deal. I just took my winnings and sort of was happy at that point in my investing career. But my mentor, said, hey, what you need to look at? You need to look at the bonus structure that was set out. And it wasn't part of the change of management. It was just a bonus structure that the CEO had worked out for himself to have the deal made. And it obviously didn't break the deal, but it was something I always keep in the back of my head, specifically for that management team. because it's something that was sort of hidden in the minutia of the deal, but it wasn't brought out there that they made, it was excess of $10 million on the M&A deal, which is significant, especially considering what that M&A deal total package was worth. So the point is that structure matters, and it matters a lot. And you need to look at each individual of those points, and then you keep notes of how those deals were structured, who made the deals, and how that might influence you in the future in terms of those people that you invest in or the types of companies and setups that you see.
We talked in prior monthly episodes where sometimes a manager of a junior miner, and sometimes they're in charge of many junior miners, they'll see a good mineral deposit or a prospective property. They'll buy that themselves and then vend it in to the publicly traded company in order to take a bigger piece of the pie. Oftentimes they can give themselves an NSR, net smelter return, or some type of royalty. Have you ever invested with a management team in which they did something like that, to where they spun out a royalty unto themselves when they vended that project into the Pubco?
Not to my knowledge.
Or is that part of your due diligence? Like when you mentioned incentives, is that something you look at?
It's funny. It's not something that's like on my list of things to try to necessarily investigate. Maybe it should be. Invariably, it's funny how that stuff sort of comes up depending on where the company is in their development. The company that we were talking about, the executive was very upfront about it. And it was because I started asking a lot of questions, because it was a new project that was just brought into the company at the time of basically when he's pitching me. And so it just invariably came up. And again, very forthright. And, I think that you can see that in two different lights. You can say, okay, on one hand, that's great that they're forthright. You can say that there's definitely an angle of honesty. As long as I ask, they're probably going to tell me the truth, because, they could have said nothing and got away with it in that instance. The other side to that is, I think that, if that's the way that management is going to, the direction they're going to go, and if they're willing to do things like that, that tells you where their allegiance is to, and it's to them first. And so you can be guaranteed that they will find some other way to do that in the future, which sort of leads back, whether that's milking the company in some sort of way with G&A, very generous option structures, or like you said, further, conflicts of interest with vending in projects. And again, probably taking more shares, taking some sort of finder's fee. Who knows? Because you can hide it so many different ways on the balance sheet. And usually it comes out, like when you look at a balance sheet, you can usually see something is wrong in terms of where the spending is coming. You just may not know exactly where it is. Again, a mentor, he maybe takes more of too much of a pessimistic view, but he just kind of supposes that he's being ripped off in some manner, and it's just a matter of time before he finds it. So he sort of takes a pessimistic view from the very beginning, which, I'm sure that was built out of experience and sort of as a protective element.
Some cultures are less trusting than others too. With people listening to us, like you're in Canada and I'm in America. I'm from the Midwest, so the Midwest is different than New York. Like I grew up on the south suburbs of Chicago, but I've been in Michigan since 7th grade, minus a few years in Tennessee and so forth. So with that being the case, that someone could come from a less trusting society in which like the default position is, this guy's trying to take advantage of me. Right. However, like you and me, when we walk across the crosswalk and there's a red stoplight there, and then you see the white colored person indicating it's safe to walk across, we're probably not thinking like, is this guy going to hit the gas and kill me and my kids when we walk across this crosswalk?
Right.
That right there is an example of where there's like inherent trust built in to society. Like, and you trust the person is going to stay on his side of the painted line when he's coming at you, right? So when I've met people, Brian, from not my culture, not the United States, there is that inherent, like, you're here to take advantage of me, aren't you? Whereas to my earlier point, that's not my general disposition. I'm not gullible, but my general disposition is like, this guy's trying to rip me off. No, I also don't go to that extreme.
Right. Well, that's a good point. It's a very good point. And again, like that, well, there's cultural, it's usually based out of experience, right? If you grow up in a society that is less trusting, it's usually based in some sort of reality of life. And, that forces you to be that way. And like, again, like I think if you listen to us and our evolution as investors ourselves, and we've been shaped by our experiences and will continue to be.
And you learn, Brian, there's so many things. Like one of the things when I see newer investors, you don't know what you don't know. And I say that from my own experience, because with like, so for example, I'll never invest in a private company or a pre-IPO company again without getting the employment contracts of the lead executives. And I'm bringing this up because of a difficult situation I had to go when it was time for that executive to go. There was like a golden parachute built into this contract if you got rid of him too early. And then the process of trying to remove him and what was laid out in that contract was like, oh my goodness, like this guy will be able to destroy the company forever. Yeah. So there's so many things and points of due diligence you don't even know that you should look for. And that's obviously in a private company or a pre-IPO company going public. But one of the things you need to get skilled on is studying the official filings, right, of the public companies. You need to study the MD&A. But even, Brian, when I've studied the MD&A, a lot of all these points of management compensation, like you really, if you study it, there, and you know what to look for, there's even questions that I have after reading the management discussion and analysis and after seeing some of the things about their compensation. And it says, yes, they are receiving compensation from a company that they owned. And then, so the question is like, what? Did you have a pickup truck that you put a gurney in the back of and you call that ambulance service? So you're charging? Do you own the building that the company is renting for? Like there's so many points of due diligence where you could take it a step further when you talk with them. But oftentimes when you do, to your earlier point, they often don't like it. And I can remember a call you and I were on, I think 2022 or something like that, where I invested in the company. You didn't invest in the company, and which was good for you. And one of the things during that conversation, I remember it being a tense point. And the executive said, he said, okay, he said, I'm not offended that you asked me that. And I remember what you said. You said, I don't care if you're offended or not. I'm going to ask the question. You're trying to raise money from me.
Yeah. I remember that vividly too.
Okay.
I remember that vividly too. And like, it's amazing, these experiences. A couple, one main point, just read the MD&A. I think if you do that, you're probably ahead of 90% of the people out there. And I think being successful in the resource sector is if you do more work than 90% of the market, you're probably going to make money. Now there's a lot more that comes to your own psychology and blah, blah, blah. But just contemplating these things is the main point, and you're not going to get it. Whatever your observation is or whatever your thought is doesn't mean that you're going to be right every time. But the fact that you're reading it, the fact that you're trying to make a decision based on what you read, and you're moving forward and correcting where you need to correct, I think that's like the bottom line and the biggest message that comes from, especially this, starting a new year. If you're not reading the MD&As, if you're not, taking a look at how money is being spent, if you're not contemplating new investments from the standpoint of structure, of the management team, blah, 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 start doing it in 2026, and you're not going to get it perfect, from the beginning. But the whole point is that you start doing it, and that becomes the biggest things. And then you'll have your own experiences to sort of feed back on and stories to tell, sort of like we're stating here. And, conferences, just getting on the phone with, you're probably not going to get the CEO, but you're going to probably get an IR person, see how they treat you. You're going to have your own sort of storyline for how you've met these different companies and in your shortfalls and the stuff you've done right. And the point is just to start having those. Just don't think about having them. Too many people just get lost in it's in your head that I want to do this and just never do it. I think that's the sort of the biggest point.
Another key point that I learned and I implemented in this last year that's a little different than prior years is that when I'm up big and I understand the multi-year big thesis, I'm going to seize those significant profits while they're accessible to me. And I'm contrasting that with an experience I had in 2021 where I was up 10x on, for me, a large sum of money. And I didn't sell one share at that time because I said, I know what the multi-year potential of this is. If it's successful, I'm going to make a lot more money. But it went up so much, so fast in 60 days that looking back, it wasn't the right decision not to capture at least some of that profit at that time. Contra to 2025, when I had nice little runs within a short period of time, then I was capturing those gains. And I know the other side of the argument is, well, you do got to let your winners run. You're not going to have a 10-bagger, Rick Rule says, without it falling by 50% at least once, maybe twice on the way there. There's truth to that. But then if you have nice profits and the tax ramifications of it aren't horrible, I seize those profits more readily, Brian. That's another one of my takeaways from the past year.
Oh, well, it just continue. I look back on my own story and I can't articulate to you or to anybody listening how lucky I was that back in 2016, when I left steel manufacturing to be an investor full time, that I had expenses that I had to take money out of the market, because my sort of mantra or my headspace was, hey, look, I made a good decision buying stuff in 2013, 2014, sort of the bottom of the market. And I held that until 2016 and I got paid. And sort of what that naively taught me was that, yeah, you just buy and hold this stuff. And there's a few people that sort of, well, there's more than a few people that sort of want to put that sort of mantra out there. But I know, like, in this experience, looking at the last 10 years, yeah, if I would have taken those investments, maybe not all of them, and just waited till maybe this year to sell, yeah, I would probably be up more than I was, especially if you look on the bullion side. If I bought, all the bullion back then and then just waited till now to sell or to have, I'd be up big time. But life happens in between that. And not all of us have huge amounts of cash or huge amounts of wealth to sort of lean back on when times are tough. And I think the psychology is just so hard to overcome if you're going to try to take that sort of way forward, especially in the junior sector. And, again, I was super lucky that I had to buy a house, that I had to buy a minivan, because our family was expanding outside of, the four-door vehicles that we had, that we needed something like a minivan. I'm so lucky I had that to take money out of the market, because those preceding 3 years were super tough and I had a lot of learning to do. COVID was a great way to implement those things that I had learned. And again, like, it was, at the time, it was my best financial year that I had had. But then again, my lessons weren't done yet. And I had two of the worst financial years I had in the preceding years after COVID. And then I had to revamp myself again, going into the end of 2023, 2024, and set me up for the best financial year of my life, which was, like, so far, which was 2025. Bottom line, again, I was super lucky to be put, or to make the mistakes I made, and to have my life positioned the way it was to force me to sell. Because if I didn't, I wouldn't be sitting here today. I would have sat on that stuff and probably sold, maybe when the COVID disarray, or maybe I would have had to gone back to steel in the preceding 3 years leading up to 2020, because I would have held all that stuff and probably capitulated with positions at half their worth or worse leading up to 2020, and it would have changed the course of my life. And so, again, when people talk about not selling, when people talk about, riding their winners, you have to be really sure you understand what you own and what that profit outlook means, and what outcomes have to drive that share price forward. Because if you're relying solely on metal price to drive things forward, and you think you can actually predict the metal price, I think you're going to be in trouble. And I think this applies to the vast majority of investors listening. Not all, but the vast majority of investors especially on the general retail end, need to take selling extremely serious. And when there's profits to be taken, you need to take that money off the table and put it into real things, stuff that we've talked about in the past.
And if something's running, this is part of my outlook for 2026. In cyclical energy and commodities and mining stocks, there's always an opportunity. They go up and down. It's a boom bust. There's always an opportunity. So if you didn't get the meat of a run in a given commodity, don't worry. Don't get greedy and try to buy some just because somebody else is up 4, 5, 7x at this point. Look for that next bottom. Be patient and understand what you're going to buy. So I take more of that mentality into this year, Brian, that there's always an opportunity. Over the last week, I spent a lot of time looking at just commodity prices, even when you don't understand the supply and demand fundamentals of even some of the niche commodities. Just go look at the charts. And then maybe that would pique your interest and you say, okay, this commodity and this metal, these are interesting. And you go from there and you just start to do a little study. Maybe you'll uncover something that somebody else didn't see. At least if you spend hours, you're going to learn something along the way. But there's always another opportunity. Don't get caught up in the fear of missing out.
Absolutely. Absolutely. That's, again, one of those key mantras. The fear of missing out is what drives so many mistakes, and it forces you, but tempts you to buy when things are at their top, and unfortunately sell when things are at their bottom, which is exactly the opposite of what you want to do. And it definitely doesn't feel, I don't think, especially at first, it doesn't feel natural, when something's going up and the hype is there to sell into that hype. But over time, and maybe, I say this, and you probably have to lose some money first for this to sort of be meaningful or reinforce the idea in your head. It had to happen with me. I had to make the mistakes first before it really honed true. And something I still need to get better at, probably in looking forward.
My last reflection for 2026 as it regards finances is just contentment. When you're content, like you're pursuing an opportunity, but at the same time, there's a contentment with, you realize it might not all come to you at once, to where you're going to take a longer term view, but you're also content with what you have. If you have a 2-bedroom bungalow in a neighborhood, maybe it's not your favorite neighborhood, you want to upgrade or whatever to a nicer subdivision or a piece of property out in the country, so be it. Have those goals, but don't have those goals in trying to expedite into an earlier season than maybe you'll be able to achieve it, cause you to make bad decisions. Just let there be a contentment to where this is what I have now. I'm striving for something greater. I'm looking for opportunities, but I'm not going to try to push it too hard, too fast, or strive for too good of an outcome too quick that's unrealistic, that it's going to cause you to make a bad decision. So that's probably my last inner reflection for 2026. And hopefully that can be useful to some listening, Brian, especially when you get into these small caps. And I've fallen into it before with just greed driving the decisions, because it's a high risk, high reward, and some of them can go up so quickly, so fast. You always got to make sure that inside greed isn't driving you and you're not putting too much at risk, and that there is a contentment. If this doesn't work out, this isn't going to ruin me. It's not going to ruin my relationships. It's not going to ruin my quality of life. So then you have to position size accordingly.
And I'll build on that. Like the last point that I sort of have, sort of builds on the contentness. And I think what it builds on in terms of your portfolio is not getting too cute. And what I mean by that is, doing too many things, too much buying and selling, trying to buy into too many different stories. I'm still one to promote the, quality is better than quantity, and understand those investments that you have and invest in less, junior companies than maybe you think you should, because so many things sound, that could be where I make money. That could be where I make money. Try to make fewer but very good decisions, understand those companies to the utmost. And then when you start selling that company, you're doing it from a logical or a strategic standpoint. And it's just not on whims. And I think the things that I continue to be reinforced is like the less that I touch that portfolio, the less that I try, or new ideas I try to flood myself with, the better I do overall. And that's because I make good decisions when I do make them, especially over the last probably 2.5 years. My decision making has become more refined, and I'm that much more confident in the decisions I do make. And what that means is when you parlay that into riding your winners, you're riding them because you understand what's going on, and it's just not a wave. I think when you're sort of iffy, this is when you can start doing too many things, buying and selling, trying to get too cute with maximizing profit because you know something that you probably don't. And that's that last point. And I think that sort of leads into what you said with like, being content with the decisions that you've made, and sort of moving down that path with not trying to do too much.
That's right. And, not follow the Joneses, right? We talk about following the Joneses to where like you look at what they have that you don't have. And then you're like, oh, I need that, so I need to make that happen quickly. No. Just enjoy what you have now. Enjoy your life. Enjoy the people God's, that's been put around you. And, you can always make more money too. I've lost a lot of money. I've made a lot of money. I've lost a lot of money. And you can always make more money. There's another opportunity for you to make more money. I believe that. Any further conclusions you have, Brian, or thoughts, reflections on this past year?
No, I think that's a really good place to leave it.
All right. Well, we got some more interviews coming up in the new year. Brian will have one out in about a week or so. And we thank you again for your listenership, and we wish you the best in 2026 and all your resource stock speculating activities.